Folks, this is John Graziano from Graziano Company CPAs with offices in Bayonne and Hazlet, New Jersey. I thought it important to review some tax tips for the new tax laws that recently took effect. Congress recently passed the Tax Reform Act that will take effect in 2018, ushering in some of the most significant tax changes in 3 decades. There are a lot of changes in the new act, which was signed into law on December 22nd, 2017. This video recording is meant to be a high-level overview of some of the most significant items in the new act. Because major tax reform like this happens so seldom, it may be worthwhile for you to schedule a tax planning consultation early in the year to ensure you reap the most tax savings possible during 2018. Here are some of the key items in the Tax Reform Act that affect individuals. The new Tax Act reduces income tax bracket. The act retains 7 tax brackets, but it reduced rates, with the highest tax bracket dropping to 37% from 39.6%. Individual tax brackets are also expanded to expose more income to the lower rates. It doubles the standard deduction. The standard deduction nearly doubles from $12,000 for single filers and $24,000 for married filing joint. To help cover the cost, personal exemptions and most standard deductions are now suspended. This limits itemized deductions. Many itemized deductions are no longer available or now limited. Here are some of the major examples. It caps the state income tax and property tax deduction, which are now limited to $10,000 for all property, income, and sales tax. This cap will have a major impact on the tri-state area. It caps mortgage interest deductions for new acquisitions or indebtedness. Mortgage interest will be deductible on indebtedness of no more than a $750,000 mortgage. Existing mortgage are unaffected by the new cap, as the new limits will go into place on acquisitions or new mortgages after December 14, 2017. The Act also suspends the deductibility of interest on any home equity loans. The limit on theft and casualty losses deductions are now no longer available except for federally declared disaster areas. No more 2% miscellaneous deductions. All miscellaneous deductions, which used to be subject to 2% of adjusted gross income, are now gone. So this will affect clients that have job-related expenses such as union dues, uniforms, supplies, travel, mileage, and meals, just to name a few. Some of the above-line deductions, such as moving expense deductions, are totally eliminated except for active duty military personnel, along with alimony deductions beginning in 2019. This means new people receiving alimony won't have to pay tax on it, but the payer will no longer be able to deduct their alimony payments to a former spouse. The new rule weakens the alternative minimum tax. The Act retains the alternative minimum tax, but changes the exemption to $109,400 for joint filers and increases the phase-out threshold to $1 million of income. This change means that the alternative tax will affect far fewer people than before. It bumps up the child tax credit. It adds a family tax credit. The child tax credit increases from $2,000 up to $2,000 from $1,000 previously, with $1,400 of it being refundable, even if you owe no income tax. The phase-out threshold sharply increases to $400,000 from $110,000 for joint filers, now making it available to more taxpayers to receive these credits. Also, dependents ineligible for the child tax credit can now qualify for a new $500 per person family tax credit. These new tax laws also expand the use of 529 educational savings plans. Qualified distributions from 529 educational plans, which are not subject to tax, will now include tuition payments for students in kindergarten through 12th grade in private schools, which wasn't allowed before. It doubles the estate tax exemption. Estate taxes will apply to even fewer people, with the exemption doubled from $11.2 million to $22.4 million for married couples. The kiddie tax. Effective 2018, the kiddie tax, which is tax on children's unearned income, such as interest and dividends, will use the estate tax and trust tax rate structure, meaning it will be taxed anywhere from 10 to 37%. This is important because this now means that children can be taxed at a higher rate than their parents are. That's what stays the same, you ask, for individuals? Itemized charitable deductions remain largely the same. Itemized medical deductions remain largely the same. The deduction threshold drops back to only having to be over 7.5% of adjusted gross income for 2017 and 2018. But in future years, it'll go back to the 10% required deduction amount. Some above-the-line deductions remain the same, including $250 educator expense deduction for teachers, and $2,500 of qualified student loan interest will still be deductible. The gift tax exclusion remains and increases to $15,000 per year from $14,000 in the previous. Farewell to the healthcare individual mandate penalty. One of the changes to the Tax Act is it suspended the penalty for not having affordable care health insurance, or also known as Obamacare. The penalty set to zero starting in 2019, but remains in place for 2018 and prior years, which means the penalty exists for 2018, but will be gone in 2019. This brief summary of the Tax Reform Act is provided for your information. Any major financial decisions or tax planning activities in light of the new legislation should be considered with the advice of a tax professional. Call us if you have any questions at either our Bayonne office at 201-858-0989 or our Hazlet office at 732-888-5554, or visit our website at www.graziano, that's Graziano, CPAs with an S.com, which has this 2018 information in the form of a bulletin including both individual and business clients. We thank you for listening and hope you found this information helpful. Thank you and have a super fantastic day.